Hello and welcome to this section on municipal securities. A lot of information is going to be coming your way on this section. It's a very highly tested concept on many exams. So we're going to walk through each of the concepts you're likely to see on your tests. And we're going to start off our review of municipal securities by defining exactly who can issue a municipal security. Well, a municipal security could be issued by a state, a county, a town, a political subdivision, or an authority such as a turnpike authority. These are all entities that can issue municipal securities, and municipal securities themselves fall into two main types of municipal bonds. Those are general obligation bonds, or GOs, and revenue bonds. And the main differentiating characteristic of these bonds is where the source of funds comes from to pay back the bond interest and principal. With a general obligation bond, it is backed by the full faith and credit of the issuing state or municipality and their ability to raise and levy taxes. General obligation bonds are subject to a statutory debt limit or voter approval. Voters must approve the amount of money that can be borrowed through the issuance of general obligation bonds because it is a draw on the tax revenue. Revenue bonds are backed by user fees. Revenue bonds are issued to build, maintain, or repair revenue-producing facilities such as a bridge, a tunnel, a turnpike with tolls. These are all supported by the revenue collected by the users. The users pay the fee to use the facility. General obligation bonds are used to build or maintain facilities that do not produce revenue, such as a local school or perhaps a county road that doesn't have any tolls. Now let's take a look at the general obligation bond a little bit more closely here. It's backed by the full faith and credit of the issuing state or municipality and their ability to raise and levy taxes. At the state level, the source of funds are sales taxes and income taxes. So general obligation bonds are backed at the state level by sales taxes and by income taxes. And some of you lucky viewers out there may be sitting in a state that have no income taxes, and we're very envious of you, but the test doesn't take that into consideration. They feel that all states have income taxes. At the local level, general obligation bonds are backed by ad valorem taxes, and that is a fancy way of saying value tax, which means property taxes. You and I call them property taxes. You own property, you pay the taxes. So these are the source of funds to pay back general obligation bonds. At the state level, it's sales taxes and income taxes, and at the local level, it's property taxes. Property taxes are based on the value of the property, and they are measured in mills. The mill rate times the assessed value of the property tells the person what their property tax liability is for that year. The assessed value of a home is not necessarily the market value of the home, but it is a base number that the town or county uses to determine what the property taxes will be on that property. So here we have an example. Someone has a $200,000 assessed value on their home. There are 9 mills. That is the mill rate for the property taxes. The mill rate times the assessed value, 200,000 times 0.009 equals an $1,800 property tax bill for that particular property. Now, municipal bonds may be issued by another entity, and they draw on the same source of tax revenue. And this is known as overlapping debt. Overlapping debt is debt that has been issued by another entity, yet draws on the same tax revenue from a nearby town or perhaps a town within a county. Let's see if we can help explain this a little bit more clearly. Let's say you live in a county, and in that county there are 10 towns. The county issues a $100 million bond to repair roads and do an infrastructure program within the county. The county then says to each town in that county, you're responsible for repaying 10% of this issue because you are in our county and you are benefiting from this program that we are undertaking. So that is an example of overlapping debt where you have a town in a county responsible for the repayment of a portion of that obligation taken on by another entity, in this case the county, because they receive some of the benefit. Let's take a look at another style of overlapping debt. If you have two towns that are right next to each other, that is known as coterminous. That means right next to each other, they share a border. Many towns that share borders will also share services. Perhaps you have town A and town B, and they're right next to each other. And town A undertakes a program to improve the reservoir that both town A and town B use to draw water for the residents. Now, town A borrows perhaps $10 million, and they say to town B, well, I know we borrowed this money, but we're using the funds to repair or to improve the reservoir that your residents all use, and you're responsible for repaying your proportional share of this debt. That is known as overlapping debt. A huge test point. States never issue overlapping debt. So perhaps you live in Chicago. The city of Chicago would not be required to repay a portion of the debt undertaken by the state of Illinois. That is not how overlapping debt works. Overlapping debt is only issued between two towns that are right next to each other and share borders, or a county and the towns within that county. Those are the entities that can issue overlapping debt, or saying it another way, those are the towns that could have responsibility for repaying a bond issue undertaken by the neighboring town or the county. Now, a revenue bond. We said a revenue bond is backed by user fees. It is known as self-supporting debt. It is self-supporting debt because you build the facility and the people pay the fee to do so. The user fees pay back the bond issue. One of the biggest questions you have with a revenue bond is, will it work? Can we actually build this tunnel into Manhattan in order to get people to use it to commute to work? How many other facilities compete with this facility? These are all important characteristics that you want to look at when you're looking at revenue bonds and the facilities that it may be used to fund. Will it work is a huge consideration. Now, all the bonds that are issued to build a facility must be paid off during the useful life of that facility. If the bridge is expected to last 50 years, you couldn't have a 100-year bond issue because there would theoretically be no bridge left to collect tolls. When revenue bonds are issued, there are certain promises or covenants that must be included in the bond indenture, and the bond indenture is a promise, it's a contract between the issuer and the bondholders. These are the promises that need to be made. One, they have to have a rate covenant or a rate promise. They promise to keep the user fees high enough so that it can support the facility and the repairs required to maintain it and the debt service required to pay back the bondholders. They must promise to maintain the facility. If the facility isn't maintained, nobody is going to use it. All revenue bonds come with a catastrophe provision or a catastrophe call. If the facility should be unfortunately damaged because of a hurricane or a tornado or a flood, all the bonds will immediately be called and insurance will pay off the bondholders. So they promise to maintain adequate insurance on the facility. All revenue bond facilities will be subject to an outside audit to ensure that the funds are being used appropriately. An additional bond test. The bonds will be subject to an additional bond test. What this means is, can the facility issue new bonds? Well, in order to issue new bonds, the facility must be generating sufficient revenue to support those additional debt service liabilities. The additional bond test requires them to demonstrate that they could pay back the interest and principal once they take on this new obligation. Now, they could have a closed-end indenture, which would say you cannot issue any new bonds with the same claim on the facility as the initial bonds. So if you had a closed-end indenture, any subsequent bonds would have to be subordinated to the claims of the initial bondholders. If you had an open-end indenture, well, then you could have new bonds having the same claim as the original bonds. Are the revenue bonds callable or puttable? A call feature allows the facility to call in or redeem their bonds at their discretion, usually after some period of call protection has expired. Or are they puttable? Meaning, can the investor put the bonds to the issuer for redemption? When a bond has a put feature, it's generally going to be based on the bonds may be put to the issuer should interest rates rise to a certain level, or the bonds may be put to the issuer if the rating on the bond declines to a certain level. Those are traditionally the two ways a bond may have a put option in the event of either of those two. Interest rates rise to a certain level, or the bond gets downgraded to a certain level. A double-barreled bond. A double-barreled bond is a revenue bond, and it's backed by two sources, meaning the debt service is first paid by the revenue generated by the facility, the user fees, the tolls. Now, if the user fees or tolls are not sufficient to support the debt service, the full faith and credit of the issuing state or municipality will pick up any shortfall. Because this guarantee is in place, that the general tax funds will be used to pick up any shortfall, the double-barreled bond trades like a general obligation bond because it does have that backstop. So that's a double-barreled bond. Let's take a look at some other types of revenue bonds. An industrial development revenue bond or an industrial development bond, an IDR, an IDB. What this is this is a private purpose municipal bond. A state or local government may issue a bond that ultimately benefits a private corporation. Well, why would a state or town or city want to do this? Well, a lot of information in the news about corporations building new headquarters, and when companies build new headquarters, it creates a tremendous amount of jobs. Perhaps the state or the city wants these new jobs to come into their area to boost the economy and boost employment. Perhaps a city says to a potential employer, if you will bring your company here, we will build you a brand new facility for your corporate headquarters. And the company is thinking to itself, that sounds pretty good. We would like to commit to doing that. Well, where is the city or town going to obtain perhaps the $500 million needed to build this new corporate campus? Well, what they would do is they would issue a bond, an industrial revenue bond or an industrial development bond, and they would use these funds to build the facility. They would then lease or rent back that facility to the corporation, and those rent payments would repay the bondholders. The important point to note here is the credit rating on these bonds is the credit rating of the corporation, not of the state or municipality. Because the corporation is ultimately responsible for paying that rent, that is the credit rating on the bonds, the credit rating of the corporation. A special tax bond is a bond where only certain taxes can be levied to pay back these bondholders. A special assessment bond. Some of you may live in condos and know what an assessment is. Perhaps you live in a condo development and they decide it's time to repave the parking facilities and roadways in your development. And then you get a notice in the mail that you're going to be assessed $200 per month for the next 3 years. Well, why are you being assessed for that? You're being assessed for that because you benefit from it. A town or a county could also issue a special assessment bond to perhaps improve the sidewalks in one area. Well, the people who live in that area are theoretically the ones who are benefiting from the nice new sidewalks, and as such, they could assess those homeowners to pay back the bond. So a special assessment bond is an assessment placed on homeowners who benefit from the improvement or the repair. If you don't live in that area or you don't benefit from the improvement, you are not going to be charged that assessment. A moral obligation bond. With a moral obligation bond, it is a revenue bond where the user fees are the first line of debt service. Now, if the user fees fall short in making any interest or principal payments, the state or town or municipality in which that facility is in must vote to allocate the funds to cover the shortfall. Perhaps there's a bridge in a town and they have $1 million interest payment due, and the revenue available to pay that interest payment is only $800,000. Well, the town or municipality may get together and vote to cover that shortfall of $200,000 to make sure that they make their interest payments in a timely manner. Now, why would they do this? Well, if they allowed a bond issued within their jurisdiction to default, it would cause the cost of borrowing for that entire municipality to go up in the future. Investors would pull back on their lending to that area because they would feel there is a greater degree of risk. A PHA or NHA. A public housing authority, public housing administration, new housing authority, new housing administration. These are the absolute safest municipal bonds on the planet. This is low-income housing. The first line of debt service is the rental income generated by the rent payments. If the rent is not sufficient to support the bonds, the federal government picks up the check. So with PHA, NHA bonds, the rental income is the first line of debt service. If there's a shortfall, the federal government picks up the check. What you need to know here is these are not double-barreled bonds. Write that down. These are not double-barreled bonds. They feel like it, they kind of seem like it, but because the ultimate guarantor is the federal government, not a state or municipality, it is not a double-barreled bond. Municipal notes. Municipal notes will be issued by state and local governments to provide short-term financing to cover any times when they have low areas of revenue. Some towns get their property taxes on a quarterly basis, and they may need their cash flow to be smoothed out until that tax revenue comes in. So they will sell short-term notes to fill that shortfall until the property tax revenue comes in. Now, you have several types of short-term notes issued by municipalities, and they all kind of sound the same. Trans, RANs, BANs, TRANs, they are all short-term paper. TANs, tax anticipation notes, RANs, revenue anticipation notes, CLNs or construction loan notes. That is what you would issue to start building a facility now before permanent financing comes into play. TRANs, tax and revenue anticipation notes. So here they are selling short-term paper to fill the at times when they have low revenue from a lull in the tax collections. Now, Moody's assigns a MIG rating to these short-term notes. A MIG rating of 1 is the highest quality, while a MIG rating of 4 is the lowest. So you want to be aware of the MIG rating. 1 is the highest and 4 is the lowest. All right, let's take a little bit of a deeper dive on municipal bonds. When a person buys a municipal bond, their investment objective is income. They want to earn interest on their money. The special thing about a municipal bond is the interest earned is free from federal income taxes. So there's a really great incentive there to buy muni bonds, especially for those high income earners who are looking to shelter some of their income or to ensure that they don't add to their taxable income. So a municipal bond is a great recommendation for someone who is in a higher tax bracket and they have an investment objective of interest income. Now up on the screen here we have a couple of different bonds, and we're going to take a look at the tax implications of the interest payment. So we have the state of resident of the investor, we have the type of bond purchased, and then we're taking a look at where the tax liability is on that interest payment. So let's say we have a resident of New Jersey and they buy a corporate bond. Well, the interest received on that corporate bond is taxed at all levels, federal, state, and local. If the resident of New Jersey buys a treasury bond, that interest is taxed only by the federal government. It is not taxed at the state or local level. If a resident of New Jersey buys a municipal bond issued by the state of New York, they will owe state income taxes in their state of residence, in New Jersey in this case. If the New Jersey resident buys a municipal bond issued in the state and where they reside, in New Jersey, it's free from all taxes, federal, state, and local. So if the resident purchases a muni bond in their own state, it's free from all taxes. Now, I want to visit one idea here that may be testable for some of you. We mentioned an industrial development bond or industrial revenue bond, which is a private purpose municipal bond, as they say. The interest income received on private purpose municipal bonds may subject high income earners to alternative minimum tax, or AMT. You want to write a note down about that. The private purpose municipal bond, in parentheses, industrial revenue bond, industrial development bond, may subject a high income earner to the alternative minimum tax, meaning they may be subject to taxation on that interest income. If someone purchases a bond issued by a territory or a protectorate of the United States, that income is free from all taxes, such as Puerto Rico or Guam. Now, you could be faced with a scenario on your exam of trying to determine which bond best suits your investor's investment objective and where they would be better off given the impact of taxes. And here we're talking about the concept of tax equivalent yield. What we're trying to identify here is where would we be better off? Would we be better off at the end of the day by purchasing a municipal security, or would we be better off by purchasing a corporate security? So they could give you a scenario, and here on the screen we have a muni bond with a 6% rate, and they give you the investor's tax bracket and they're in the 30% rate. Where would the investor have to be on a corporate bond in order to be at the same place as the muni after taxes? This is the concept of tax equivalent yield. Well, what we need to do is we need to take that muni rate and then we divide it by 100% minus the investor's tax bracket. So here we have 6% divided by 100% minus 30%, and we end up with 6% divided by 0.7. We divide 0.7 into 6, and we realize that we would have to receive 8.57% on a corporate bond to be at the same place after taxes. Now, if the corporate bond offered more than 8.57%, we would be better off in the corporate bond. So perhaps it offers 8.6%. That would be the better choice. If it offered less than 8.57%, perhaps 8.50. Well, then we would be better off in the muni, because once taxes are taken into consideration, the muni results in a higher after-tax income. Now, they could also give it to you another way. They could show you a corporate bond rate and say, where would you have to be in a muni of equal quality? Well, in this case, we take the corporate rate, which is subject to taxation, and we multiply it by 100% minus the investor's tax bracket. So here we have a corporate rate of 10%, and we multiply it by 100% minus that person's 30% tax bracket, and we end up with 10% times 0.7. We would have to receive at least 7% on an equal quality municipal security to be at the same place. If the muni bond had a yield higher than 7%, we would be better off in the muni. If the muni bond had a rate less than 7%, we would be better off in the corporate. We've just done a great review on some of the basic concepts that you're going to see on each of your exams. Make sure that you have mastered these concepts and understand the fundamental differences between general obligation bonds and revenue bonds, and have a good handle on the source of debt service. Please review this video again if you're looking for further clarification, and we'll see you in the next section.